The markets today finished lower. Traders, they reach for volatility on the back of Fedwatch's remarks, and the market is looking like a coiled spring. All that and more on today's Stock Market Brief Show, where we navigate the financial markets through the lens of technical and intermarket analysis. Make sure to check the pinned comment or the description below for links to download this chart deck for free. I also offer my Patreon group. It's $9 a month. It's a swing trading community where I give some trade ideas, my watch list, which I update weekly, a lot of different names on there, and I include a tight list, all the names that are contracting. Contraction leads to expansion. And then we give monthly, quarterly, weekly, daily expected moves. I include the zones indicator, which is based off of the bridge bands. It allows you to see a fractal view of the market. I extract bulk data from it and visualize it in a different way that's really cool and unique. Stock market indicators, which are just my permalinks to some of my chart decks, the ones that I share here on the show. Permalinks are hyperlinks to some of the educational videos that I've already shared on YouTube. It's just more organized there. You get the entire Trady Ticks bot, which includes various different options, flow type of stuff like bullseye bot, Trady Flow, large sweeps, golden sweeps. You get dark pool bot, and then you even have the query. And the query is very cool because this allows you to type in various commands for certain different stocks or markets to get more valuable information and research from a deeper perspective, whether that's gamma levels, open interest, and so forth. So very cool stuff. It's only $9 a month. I don't charge an arm and a leg, or you pay annually and you get to save some. That's all I got on that. We're going to get right into it today. So out of the 11 sectors, the only one that finished up was technology, and then consumer discretionary finished flat. So pretty much a risk on type of day, but the market did finish lower as stated, and traders seem to be reaching for potential protection. Now, this doesn't mean hedging for protection means that the market's going to be coming down in the near future, but why would they be reaching for potential protection? We got to look into that and what's really taking place on the overall market. So that's what we're really going to do today. We'll start off by looking at the ES chart, and just from a candlestick perspective, you can just see the opens and closes and the bodies and the ranges. The ranges are basically the low and the high. The body is where we opened and where we closed. You can see we're getting pretty coiled up here, right? So we saw a pretty strong move down to the beginning of the year. We bounced and recovered, and now we're kind of coiling up. So the question is, are we going to get unpinned, boom, and start to see a stronger move, or are we going to get unpinned and go this way? You really see it here on the Nasdaq. You can take a look at NQ. Very, very, very small bodies, which means that it's indecisive. The price action is indecisive. The price action is currently pinned in a very small area, and when the unpin happens, when the coil is released, we can see an explosive move. Now, it could be a potential catalyst that causes this, or it can be potentially the runoff in gamma, which we'll get into momentarily. But going into tomorrow, we do have retail sales number an hour before the market opens up. But more importantly, we do got a lot of Fed speak taking place, and that's going to be one to pay attention to. I'll show you why here in a moment. Thursday, same thing, right? We got building permits, but we also have Bostic, and we got more Bostic. Some boombastic speeches right here, okay? Friday, same thing. Michigan consumer sentiment, and we get more Fed speak. So today, I guess the market didn't really like what Fed Waller had to necessarily say, but just look at the response when he comes out. You could sit there and try to analyze word by word, or you can just watch what the market does. Well, look at what the market did. Within, 2 minutes, right? We had a range of a candle and massive volume come in, right? When he came out and talked, or when his speech was released, from about 48.12-ish down to about 47.94 in a matter of 2 minutes. Yes, it recovered, it moved up, and then went back down. But just understand that that's a big, warning shot to let us know, be careful when Fed members come out and speak, because what they say can have a dramatic effect on the market. Now, that's just ES, but take a look at the bond market, right? 30-year U.S. Treasuries, we're looking at ZB, massive move on the back of Fed Waller's comments. So today was really based off of what he had to say. Not only that, if you look at the Fed Watch tool, look at the March meeting, right? We're basically slated in stone to keep rates where they are in January, but then we're talking about rate cuts. And well, we had about a 77% chance of a rate cut, the probability of a rate cut, which was high for the March meeting. But look how it changed today. It went from 76.9 down to 64.2. So we saw the dramatic, move. It's still, basically moved to a coin toss for the most part. So the market's still saying, hey, the higher probabilities are we're going to cut rates, but then the market today, they said the likelihood of a rate cut went down, and the market, didn't clearly like that all too much, including, small caps the most. Okay, so let's continue on. We looked at that. Now, if we take a look at the 10-year, 2-year yield curve, what's been going on here? Well, it's starting to been steepen up again, right? And as it's steepening, we could potentially go into that inversion, and it's still inverted, but now we're only 15 basis points inverted. So this thing has been moving, and that from what we've shown before and seen through history since the inversion is not necessarily a good thing for markets. But if you take a look at the 10-year, 3-month, we're still, yes, we're moving up, but we're still well off, being uninverted. It's still 138 basis points inverted. Now, the reason why I say it's not always good if we start cutting rates and the yield curve gets uninverted is simply just by looking at history, where we go through a rate cycle, we get inverted, we uninvert, rates go down, and then the market sees massive amounts of volatility. That was the pandemic, so it could be a one-off. But if you want more information, go down to the financial crisis. It was the same thing. Rate hike cycle, we kind of went uninverted, we inverted again, and then we uninverted, and then we uninverted again, and we went through the rate cuts. We had a strong steepening of the yield curve. We saw all that volatility, and then back over there in 2001, the dot-com bust, rate hike cycle. What happened? Yield curve was inverted. We uninverted, and that's when the volatility came in. So I don't know if it's going to play out the same way. Clearly, we show this chart frequently just to kind of keep an eye on it. But I mean, if the same thing were to happen, if we get these massive bouts of volatility, wouldn't you rather know ahead of time versus be unprepared and caught off guard? 10-year yield shot up today too, up 2.94%. We had this price momentum oscillator crossover at the beginning of the year, and we said, watch out for it to potentially move up. Then it looking kind of like a bear flag where it can potentially go down and be good for IWM, but we'll continue to monitor this and see how it takes place. But right now, still a bullish crossover below zero, and the price action of the chart is looking decent in the very short term. Okay, bouncing from oversold areas. Take a look at TLT, same thing. It was wedging out, it's kind of looking nice, but today got a pretty big hit on the back of those remarks, down 1.76%. And then another thing to pay attention to from an intermarket standpoint is the dollar, right? We know when the 10-year yield goes up and the dollar goes up, that's not necessarily good for markets. We pointed that out at the beginning of the year, pointed it out before the year, we pointed it out on prior videos, and we've shown time and time why that is. And if you just look at this chart, right, when the dollar gets cracked down, what does the market do? Well, as the dollar found its top over here in October, the market found its bottom. It started to rally. Then the dollar started going up here, and we had a 10% correction in the S&P 500, roughly 10%. And now price action started wedging, getting very tight, giving us the opportunity to say, hey, the start of 2024 might be actually pretty bullish for the dollar. Well, we got the breakout, and we continued higher right at about 103.4. But what's interesting here is the S&P 500 hasn't really reacted to that, but I do find it interesting that they haven't reacted to it with a negative correlation, but today we're starting to see, a reach for that volatility. Now, let's get into some gamma talk. So gamma exposure levels, if you look at the percent expiring of the total by date, so this week, we're having about half of the gamma expire, maybe a little bit more. Okay, so what this means, in simple terms here, we've been having this 4,800 pin, and price action gets to it, and then we get pushed off. We came up to it, pushed off, came up to it, and we pushed off. And you could see price action has just been kind of just, pinned within these couple of levels. And if you look down beneath us, we don't really have too many main levels. The big one to watch for is the gamma flip level. This is where dealers really have to change the way they position. What I mean by that is when they're in positive gamma territory where price action is above it, dealers look to buy the dip, sell the rip, buy the dip, sell the rip, and you get a steady, conservative move. Today we almost tested that level, but we bounced a little from it. However, when we get into negative gamma territory, that's where dealers look to sell into selling, buy into buying, and you get much more volatile price swings. And it seems to me that that's what kind of dealers traders were positioning for today, looking at the volatility index. Now, if I look down the list, you look at 4,700 and then 4,650 and then 4,600 would be those key strikes. The bigger one is 4,600, and these aren't all too big, right? So if we really get unpinned, if gamma runs off and it allows the market to just move more freely and kind of get unhinged, pull the plug on this gamma, if the market were to start, getting hit to the downside and go negative, it definitely opens the door for these lower levels to get tested. Now, from a more bullish standpoint, we'd want to be back more up here by 4,800, and that can open the door for, a monster move getting unpinned, that is to say, when gamma runs off by the end of the week to start moving up higher. And we'll map out some of those key levels. If you just take a look at the SPX, look at the daily expected move. I didn't actually update these daily expected moves, so ignore these ones. I'll show you them on the SPY. Today, we basically went under it and closed just above it, right? 68% of the time, sometimes more than that actually with the SPX because it's a larger project, closes within there. But we have a wide open weekly expected move. So the lower is 47.31, and then the above is 48.35. As it stands right now, we're below the 5-day moving average, or basically right on it, and it's still inclining at this time, and we're in positive gamma territory, so check. That's actually bullish, but we need to be able to hold that, right? Or things can change, because we're not far off of the gamma flip line, and well, we're really not far off of the 5-day moving average starting to turn over if we get more weakness. If we take a look at the SPY, there's a couple interesting levels that I want to map out. The year-to-date anchored VWAP, we're still above that, so that's bullish on the year. It tells us that the average buyer based off of volume in that time is in the green. We close right at that 5-day moving average, like I said, and it is inclining, and we're above the week-to-date, which is technically the daily anchored VWAP here too as well. If you want these levels on your chart, go ahead and download the chart deck so you can put them. Though the white lines is the daily expected move, the orange is the weekly, and then I included some daily 2 standard deviation moves if anything were to come out and we get a surprise. You can always watch those levels because 95% of the time will close within this range of risk right there, okay? So overall, it's not necessarily a bad thing. It's a little undecisive in this current moment. I'd still, lean more bullish, but you have to be ready to quickly turn that coin when this type of gamma runs off, and you don't really have too many supportive strikes beneath it, and you're not too far from negative gamma territory, okay? So gamma flip line, 5-day moving average turning back down, be patient, wait for it to turn back up to be a little bit more, bullish. If we take a look at the bookmap levels, I did find a couple interesting levels here to pay attention to. There's some liquidity beneath us at 47.77 and then, kind of 47.80. I would pay more attention to this one, 4777.5. That's over 500 contracts, over 400 contracts seems to be a pretty decent, big deal. And it's been there for quite some time. And we, the longer it's there, the more likely we'll fill that liquidity. So keep an eye on that level to potentially act as a level of support, or for price to just get down there and absorb the liquidity and kind of see what goes on for that point. I don't necessarily would say buy the dip right there, right? You always want to wait to see if price action picks back up and you see some strength. If we zoom out of all of that talk and you just look from a price action perspective on the weekly time frame for the SPX, we're down slightly on the week, right? Just day one. We're still above a rising weekly 5 EMA, and we're just having an inside week. So right now it's literally just consolidation. So it's nothing necessarily to just bear completely up on. It's just we're preparing ourselves. If there is a turn, we can be early to the turn and protect our capital. That's all we're doing here. If you zoom out a little bit further of the weekly chart, you can still see we do have that negative divergence on the price momentum oscillator. And as you can see, price was high, price is higher. The momentum is basically flat. So if we get back underneath the 5-period weekly EMA and we have a bearish crossover, obviously that opens the door to test a little bit lower levels. And then the last thing I want to end with is just this chart and the NYSE one as well, the Nasdaq Summation Index. We're still at that potential change in trend. You can see we turned over 1, 2, 3, 4, 5, 6, 7 trading days ago, and that identifies a potential change in trend or a period of consolidation. I marked it out multiple times of what that may have looked like, and you can see here what happened when we flipped over, which is basically almost the start of the year. We went down, we came up, and really we're just kind of going sideways. We did have that negative divergence that started to play out, but really it's just price actions overall consolidating. And if I look at the Nasdaq McClellan Oscillator, a pretty big hit to the downside today, and we haven't seen any positive moves basically for the entire year. So if you want to be more bullish, it'd be nice to see this turn black, which would be a positive read. Or sometimes when you get oversold conditions, it can mark bounces too, as well, as we pointed out multiple times. If you look at the NYSE Summation Index, the same thing. This thing is turned around, identifying a potential change in trend. It's kind of down on the day. This thing is also getting pretty extended to the downside here as that negative divergence is starting to play itself out. But to be more bullish, you'd obviously want to see this eventually turn back up, the parabolic start to uptick, and that identifies a potential bullish change in trend. So we have a couple of things that are back. We're at a very precarious level right now, right next to the gamma flip line. We're right at the 5-day moving average. It's rather flat, but slightly inclining. It's a time to be very patient and be very tactical here, because you don't want to get caught on the wrong side if this pin is pulled and the grenade explodes. And by explosion, I mean it could explode to the upside or it could explode to the downside. So watch those weekly expected moves. I personally believe that once we're kind of unpinned, it could be Thursday, Friday, where we get a stronger move to be made aware of. That's all I got for you. See you later.